Today's lesson will be on group disability income insurance, or basically group insurance that we're talking about here. When we talk about group insurance, you remember that group insurance is really a third-party contract. In other words, what happens really is there's a master contract. That master contract is actually put together by your employer. So in other words, it's not you who actually is doing this as an individual, but it's actually your employer actually has the master contract. So that's why they call it a third-party contract. You, as the individual, are what they call the group person insured, or group insured. In other words, what you get really is as proof. You get a certificate in your hands. Many of you probably have a little card in your wallet that basically said this is what you're eligible for. So group insurance, by its very nature, is a third-party contract. There's also two types of group insurance plans. It's what we call a standard group, which essentially is 25 or more lives, or in other words for them, it's a larger group. Anything less than 25 lives will in fact be considered a small group. And again, that has significance when it comes to pricing of the product and everything else. And that's why they distinguish between a standard group and a small group, basically. There's two types of individual group plans. Basically, is what they call a contributory plan and a non-contributory plan. A contributory plan is basically that you and the employer actually split the cost, you might say. Most of the time it's 50-50. So you pay $1, the employer pays $1. A non-contributory plan basically means that you as the employee do not contribute anything at all. The employer basically pays 100% of the actual benefit. Now, when it comes to group insurance, one of the things that's very, very important is that we cannot discriminate between classes. In other words, what you're going to get is you're going to get employees, for example, that everybody will have exact same benefits. But you may get management, for example, have a different set of criteria. So basically, you cannot discriminate between classes. You can certainly within the class itself. Everybody must have the same thing. So if everybody is a white-collar worker working in an office, for example, then those people must all have the same benefit. If you are management, all management must have the same benefit. So once again, the discrimination clause is very, very important, that you cannot discriminate within the actual class itself, but you can certainly do it between classes. And the last thing that's very, very vitally important is what creates an eligible. How eligible? When do you become eligible to, in actual fact, get benefits? The first thing is you must be actively at work. But definition of actively at work is very important. In other words, you cannot be on claim already. Okay, it has to be that we stress that you must be able to be working that particular day when the plan comes into play. The second part of it is probationary period. Usually what happens is the employer will ask a new employee for basically 30 to 6 months, 30 days to 6 months waiting period before, or what we call a probationary period, before you're actually eligible for benefit. And once again, the reason for that is to try to eliminate any unforeseen pre-existing conditions, things of that nature there. And the last thing, of course, is what we call the eligibility period. Once the probationary period is over, so for example, if your employer says you're 90 days, you're not going to be covered, but on the 90th day that coverage starts, then the eligibility period kicks in. In other words, you must now sign up within 30 days of the probationary period being actually over with. After the 30 days, the insurance company may in fact ask you for medical information. So therefore, if you actually do it within the 30 days, then you are in fact eligible.